Hey guys, welcome back to another Monday, and today we're going over week 11 of my TFSA portfolio. So today what I'm going to be covering in this video is talking a bit about lumber prices because that impacts my stock Stella Jones, and we saw that stock drop from around $52 to about $46. Then I'll go over my total portfolio, and at the end we'll talk about a few questions from last week's video. And if you guys haven't yet subscribed to this channel and have been watching the series, consider subscribing down below. So talking about lumber prices, the reason why I want to bring this up is because I think it also relates to the housing market in Canada. And one thing that I've kind of noticed in Canada here, or just around the world with the whole pandemic and how the workplace has shifted, how people are working from now on, is I think that we're going to go to a hybrid model where people are going to be working a couple days or maybe 3 days at home, and they're going to go into the office for maybe 2 days of the week. And what this means is it's a requirement for a lot more space for each person or each adult. And I think the reason why there's a lot of demand in the real estate market right now is because people realize they need extra rooms in order to set up their home offices. If you got a mom and a dad working and they're living in a 2-bedroom apartment with a couple of kids, then that's not workable. You need to have at least a 3-bedroom house and to have maybe an extra space for a den. So for these types of situations, we can see a lot of these families moving out of their smaller residence and upgrading to larger houses. And that's why we're seeing, or at least that's why I think we're seeing an increase in house prices. And that's why people are buying into houses, as well as people are going out there looking for places to store their money instead of cash, because cash is eroding as the government continues to print money. And the fact that new houses that were coming online in the construction market, they got slowed down at the beginning of COVID, and I don't think the sawmills have fully recovered yet. So the construction of new houses, essentially the supply of new houses, is slower than the increase in demand. And the fact that the markets are still hot after a year, I think that this demand has not yet been met. And I think there's also another group of people like millennials. They used to live together as roommates, but now with the whole pandemic, people would rather live in their own space and they need an extra room. They can't just rent out one room right now with a couple of friends in a house. They need at least 2 rooms, one to sleep and one to work in. So the conclusion from this is the demand for space has increased instantly as the pandemic happened. However, the supply could not increase instantly because that's dependent on the new houses or new properties that were built. So we're still trying to catch up with the demand, and therefore lumber prices skyrocketed. And they probably will continue to skyrocket, or at least stay at these elevated levels for the next couple of years. At least that's my opinion right now. Maybe you have a different opinion. I'd love to hear your opinion down below. So here I have a chart of lumber pulled up. You can see in the depths of the 2020 stock market crash, it was trading at around low $300. And then just in the span of a year and a half, it's risen all the way to $1,323. That's basically a 4x in lumber prices within a year and a half, which is absurd in my opinion. So here on CBC, this article titled "Record High Lumber Prices Add as Much as $30,000 to the Cost of Building a House." When the pandemic hit, lumber mills were forced to close. Then a nation of people stuck at home started building more decks and fences. People renovated to accommodate their new work-from-home lives. So from this sentence, we see that there's been a supply squeeze when lumber mills were forced to close, and there's a demand spike when people looked to build more decks and fences. In this other article, record lumber prices dragging homebuyers and renovators to the woodshed, it states that housing demand proved surprisingly resilient during the pandemic and increased abruptly during the second half of last year, catching many building products producers by surprise. The pandemic spurred demand for the most useful living space to accommodate working from home and remote learning. This abrupt shift in the demand fueled a surge in renovation and repair spending and set off a wave of home buying during the second half of last year. Customers ready to expand and upgrade their living spaces have already been leaving pricey coastal cities in droves, looking inland towards markets that by comparison remain in the realms of affordability even for modest incomes. And that interest is draining inventories of existing homes and driving demand for new construction. So seeing all those videos of people exiting California and going elsewhere, this is why the demands for homes are going up in the States. Further in the article, it reads, "We're in this great demographic cycle for home buyers. If you look at it nationally, 32 million Americans between 27 and 33 years old, the prime age group for home buying. COVID-19 didn't create new demand because it was already there. What COVID did is accelerate the trends. So I do agree that COVID did accelerate the trends for millennials between the age of 27 and 33 looking to buy houses. So those guys jumped into the market like myself. However, I do think COVID also created a need for more space. So as I mentioned before, home offices became more of a thing, and some people even want 2 home offices, one for the wife and one for the husband. And then maybe you need another room for your kids to learn in. So the demand for space has gone up dramatically as people are working from home as well as learning from home. And as I mentioned before, their hybrid model of working from home and going into office, half and half, is going to continue to create this need for space where people after the pandemic will still need their home offices because they'll be working from home part of the time or maybe going fully remote like some companies are doing. Just quickly looking at Stella Jones's Q1 report, they stated here that their sales on residential lumber increased to $99 million or increased by 139%. I guess, mind you, this is an increase over last year, Q1, which was when the pandemic first hit. So 1/3 of Q1 was actually where the market was falling dramatically. And if we scroll down further here, we can see the outlook for the next year. For residential lumber, sales are now forecasted to increase in the range of 45 to 60% compared to 2020. So Stella Jones is expecting that sales will not be increasing by another 139%, but rather 45 to 65%. So when Stella Jones released earnings on May 3rd, you can see the stock price has continued to drop ever since then. It dropped from highs of almost $54 per share all the way down to $46 per share today. It looks like the shares have come back down to where they were trading in the late half of 2020. And if we zoom out a little bit more, we can see that Stella Jones has been fairly range bound since 2015. So even though I bought in at all-time highs around the $52 or $53 mark, I look at their income statement and see that they're continuing to increase their operating income. You can see this is a trend over the past 10 years. So even over the past 5 years when the stock was flat, they're continuing to increase their operating income, which is good for me to see. And they're also increasing their net income to shareholders, as we can see from this chart here. And when we look at the company, they have a dividend yield of 1.56%, and they do have the cash flows to support that dividend. So I guess with me talking about lumber prices and Stella Jones, I do plan to continue to add more this week as the prices have come down fairly significantly from my cost basis. Looking at my portfolio, Stella Jones is basically the third last stock in my portfolio in terms of market value. It's down to almost 10% from my cost basis, so I will be adding more to be able to lower my cost basis. Before I talk about other stocks that I'm looking to purchase this week, let's go over last week and what I bought. On this transactions tab, we can see that the 4 transactions that I made last week was buying more of the Bitcoin ETF. I bought 1 share of POW. I also bought a few shares of Algonquin Power Corps, and I also bought 2 shares of Well Health Technologies, as I do believe they were undervalued when the shares are trading under $7. Again, I bought more Bitcoin ETF just because I know this asset is very volatile, and the share price dropped to $6.82. And if we look at my cost basis for the Bitcoin ETF, we can see here on this line that it's around $8.58. So yes, I'm down about 24.55% on this position, and some of you guys may call me crazy, but I do have high conviction by the end of this year, Bitcoin will go back up just like it has in the past, and it's following the same trends as 2017 and 2013. So yes, I'm down right now, but Bitcoin is a volatile asset. Even within the single week, we can see that it started off at $7.42 and actually fell by 12% over 5 days. So it ended off the week in a very poor position, but as I said, this asset is very volatile. It can swing up and down, and I do believe that we'll see prices of $8.50 once again, and I'll probably go higher than that, and that's my opinion, not financial advice though. Another stock I'm looking to add is Enghouse, as I'm down about 12.61% here. And I think Enghouse is just being grouped in with all the other tech stocks where they've got hammered in the past couple of months. So right now, I believe the market is very fearful of these tech stocks and higher growth stocks, and they have yet to return to their previous all-time highs, and rightly so. However, Enghouse I do think is a solid business, And if we look at the companies, we can see that they pay a dividend of 1.21%, so this company is profitable. They have a P ratio of 28.62%. And on top of this, we can see that Enghouse continues to increase their cash from operations. In 2020, we can see a significant rise from their cash from operations, and it basically doubled what they did in 2019. If we go to their income statement, we can see the income continues, or the revenue continues to grow year over year. So there's a steady trend, with 2020 being an anomaly where it jumped up significantly compared to the previous years. So Enghouse as a business, just looking at their past performance, has been performing fairly well in my opinion. And the fact that the stock price took quite a big hit, just if we search that up here, we can see the stock price was trading at around $80 or $70 per share, and it's dropped 31%, even though nothing really major with the business has changed. Now it's trading at levels that it was trading pre-pandemic. So before the whole COVID-19 thing hit the stock market, it was trading at $54.75, and today we're trading at $53.10. So I think that a company that's gone through a year where it's increased its earnings significantly, its revenues basically increased by 30%, yet the stock price hasn't really moved anywhere. I do believe that there is value seen here in Enghouse right now, and for that reason, I'm looking to purchase more this week as the price continues to come down. Now moving on to two questions from last week's video. The first question comes from Wilson. Is it smarter to make a TFSA account on Wealthsimple or just use a normal account? So my opinion is, if you don't have a TFSA account in any other brokerage, then yes, open up on Wealthsimple. If you haven't maxed out your TFSA account on another brokerage and you're interested in buying Canadian stocks, then open up a TFSA account on Wealthsimple. And the reason is, I believe that Wealthsimple offers the best option for Canadians right now, especially if you're not trading with large sums of money. If you're trading like $50,000 at a time, then Wealthsimple is probably not for you. But if you're trading anywhere from like $100 to $1,000 per transaction, then Wealthsimple makes a lot of sense. Wealthsimple may take like 50 cents on the bid-ask spread, or 50 cents more than another brokerage, because they have to make their money somehow. But when you compare the extra 50 cents that you're paying in the bid-ask spread on Wealthsimple versus the $5 or $10 commission fee that you're paying on Questrade or TD, then that's peanuts. So the conclusion is, I would open up a TFSA account on Wealthsimple if you don't have one that's maxed out on any other brokerage. And in terms of the normal account, I would open up that one as well. It doesn't hurt to have a normal account. There is no account fee. So you can have the normal account open in case you max out your TFSA one day, then you don't need to wait 3 days or so for the account to be approved. So short answer is, open up both if you don't have a maxed out TFSA on another brokerage, and if you do, then just open up a normal account on Wealthsimple Trade. The second question that we have comes from Mr. Sammy. How come you aren't adding to your WellHealth position to average down? Do you feel it has too much negative pressure on it? So I guess in this episode, I showed that I did add a little bit to my WellHealth position. I added 2 shares. And I think right now there is no rush to add to WellHealth. The telehealth sector has been depressed. If you look at WellHealth stock, it's been trading fairly flat. If we go over to Dialogue stock over here, we can see that Dialogue, when they IPO'd, it was a hot IPO. There was a lot of demand for it, even though the whole telemedicine sector was depressed at the time. It shot up by 35%. However, since then, from the peaks, it's dropped by 38%. So we can see here that although Dialogue was a hot stock when it came on, the demand for telehealth is not there right now. And unfortunately, WellHealth is grouped in with all these telehealth stocks. So I would say right now there is no rush to buy WellHealth, and I do think it has a good long-term business. So I'm being very picky when I'm buying in. I think prices around $6.75, or if it drops below that, these are great times to get in. But also with the amount of WellHealth stock that I do own right now, I'm not like itching to add a lot more. I would say that if the prices drop to like $5 or $4, then I'll consider adding a bit more to my position, like a sizable amount. And if it drops to $3 or $2 and they continue to have a solid business, that's when I'll load the boat and possibly even double my stake in it. But right now, with prices flat, I don't see there's any rush to buy WellHealth Technologies. I'm already comfortable and happy with the position that I have across all my portfolios. And within this TFSA account, I'll just be adding slowly like I have been doing to other positions. Anyways, that's all for today's video. If you guys like this video, leave a like down below as it really helps out the channel, as well as subscribe and hit that notification bell if you haven't done so already. I'm going to throw up 2 videos on the screen in a second. If you're there, I'll see you there. If not, keep up the grind and have a great day.